Moving money through a massive economy requires immense physical effort when the entire financial system depends on paper. Every single transaction means physical bills have to be printed, transported, guarded, and counted. Just keeping that physical system supplied was an expensive industrial operation. The Reserve Bank of India was spending roughly $600 million every single year purely to manufacture physical currency. By 2016, the reliance on that paper was nearly absolute. 88% of all daily commercial exchanges in the country were still conducted in cash. The country was experiencing rapid 21st century economic growth, but its actual commercial velocity was constrained by a 19th century medium of exchange. Down at the street level, commerce moves through dense informal markets where millions of small value transactions happen every hour. Western financial tools like credit cards failed to gain traction here. Micro merchants operated on margins so thin that they outright refused to accept cards, avoiding the high merchant discount rate fees attached to every swipe. On the supply side, a severe lack of physical banking infrastructure, especially in Tier 2 cities and rural areas, left a vast majority of the population without access to formal accounts. Even when early digital payment tools did appear, they were unstandardized. Consumers were deeply hesitant to adopt them, fearing fraud and digital theft in an environment lacking a central security framework. High transaction costs and siloed systems meant that for most micro-merchants, adopting digital payments would effectively eliminate their profits. The solution required a departure from private corporate networks. The Indian government opted to build a digital public infrastructure, known as the Unified Payments Interface, or UPI. This diagram outlines the shift. Historically, banks operated within silo payment frameworks on the left. Customers were served in a highly fragmented way. UPI replaced those silos with an open-source, centralized rail bridging the remitter and beneficiary banks directly, allowing instant settlement. As Bill Gates observed, the ambition was vast, a system capable of routing rupees seamlessly between any bank or smartphone application in the country. By using open APIs and proxy-based accounts, the system allows a simple smartphone to function as a mobile terminal for both merchants and customers. This architecture handles identity verification and instant settlement digitally, allowing the network to scale without the overhead of physical real estate in rural areas. The system operates on a highly unusual economic model. For merchants, processing a transaction on UPI is effectively free. Curiously, in a single year, the network processed 114 billion transactions. How does an infrastructure of that immense scale sustain itself if it isn't charging merchant fees? This chart illustrates the explosive adoption triggered by removing those costs. In 2016, there were only 2.5 million expensive point-of-sale machines. By 2023, the system scaled over 100 times, reaching 256 million easily printable UPI QR codes. The platform shifts the primary economic value from extracting transaction fees to capturing digital transaction data. Every digital exchange creates a formal record, converting previously invisible informal trade into a verifiable ledger. A street vendor who previously operated entirely in cash and was completely invisible to banks now generates a consistent credit history through hundreds of daily microtransactions. Eliminating friction at the point of sale gave millions of informal vendors their first verifiable financial identities. This allowed them to access formal credit, expanding the entire economic pie. Over a 7-year period, this high-volume, low-friction architecture triggered a quantifiable macroeconomic shift. This graph maps that divergence in economic behavior. While digital payments skyrocketed into the billions between fiscal years 2016 and 2022, the growth rate of physical currency in circulation steadily flattened. Simultaneously, the system deployed a centralized anti-fraud solution using machine learning to assess risk in real time, neutralizing the public's initial fear of digital theft. This pairing of high security and frictionless access has placed a nation of over 1 billion people on a direct path toward becoming a less cash society. This domestic success directly intersects with the current goals of international institutions like the Bank for International Settlements, which actively manage global financial stability. Central bankers worldwide are currently facing a specific dilemma. They are searching for reliable ways to anchor trust in money and drive financial innovation beyond the volatility of crypto assets and stablecoins. In that search, India's UPI has emerged as a proven, scalable case study for addressing these global monetary challenges. The structural lesson is clear. When a government treats digital financial interoperability as a basic public utility, providing it the same way it provides roads or water, an entire economy can leapfrog a generation of technology. The search for the future of global money led many toward complex, decentralized cryptocurrencies, yet the most effective answer proved to be a centralized, open-source public good that made paying for a glass of milk entirely frictionless.